All right, so we just concluded our introduction, and now we're going to start moving toward the mechanics of this framework, starting with the aggregate demand in Keynesian analysis. So this video is going to lay the foundation for understanding how the Keynesian model views the economy. At its core, this perspective emphasizes the role that total spending or aggregate demand plays in determining the overall level of economic activity. We're going to break down what aggregate demand is, what influences it, and how it directly impacts key economic indicators like output and employment. Here are the learning outcomes. We need to explain real GDP, recessionary gaps, and inflationary gaps. We need to recognize the Keynesian ADAS model, identify the remaining determining factors of both consumption expenditure and investment expenditure, and then analyze the factors that determine government spending and net exports. So let's start with the fundamental idea here, which is that the Keynesian perspective focuses intently on aggregate demand. That principle is pretty straightforward. Businesses only produce goods and services if they have the anticipation of being able to sell them. We're not going to just stockpile stuff just for the hell of it. We're not going to make things just to have them sit in a warehouse. While the economy's potential output or potential GDP is determined by the availability of factors of production, things like labor, capital, technology we've talked about, the actual amount of goods and services that are bought and sold, which is what we call real GDP, that's dictated by the level of overall demand across the economy. So in the Keynesian view, it's not enough to have the capacity to produce. You also need sufficient demand to drive that production. Capacity is one thing. Yeah, we can make a lot of stuff, but do we have people who are asking for it? To illustrate this, let's look at the Keynesian ADAS model. So this model is a slightly different view of the aggregate supply that you might have seen in other economic schools of thought, which we're going to talk about more in the next chapter. But in the Keynesian view, the short-run aggregate supply, or the SRAS curve, is depicted as horizontal at levels of output below potential GDP. Let me zoom in here so you can see that just a little bit better. There we go. So this means that when the economy is operating below its full capacity, changes in aggregate demand primarily affect output levels, not prices. So think of it this way. If there's a lot of idle capacity and unemployed workers, businesses can increase production without necessarily needing to raise prices or wages. However, once the economy reaches toward potential output, the line YP there, the right bottom vertical line, the SRAS curve becomes vertical. And at this point, the economy is at full employment, and any further increases in aggregate demand will only lead to higher prices or inflation, because there's no more capacity to increase real output. Conversely, any decrease in aggregate demand from potential output will affect only output, causing a recession. But prices may not fall. So Keynes argued that aggregate demand is not inherently stable. In fact, he believed it could change unexpectedly. Suppose the economy starts at full employment, operating at its potential output. If aggregate demand suddenly falls, well, then the economy can find itself in what Keynes termed a recessionary gap. This is a situation where the economy is in equilibrium, but with output at a level below its potential GDP, leading to unemployment. Keynes was particularly concerned about these gaps because he believed that the economy could remain stuck in a recessionary gap with persistent unemployment for a significant period of time without active intervention. Conversely, if aggregate demand rises excessively, pushing the economy beyond its potential output, then it leads to the inflationary gap. Here, demand is trying to expand the economy beyond its sustainable capacity Everybody's working 24-hour shifts, overtime. Machines are going nonstop. It's not sustainable, right? If demand exceeds that potential GDP, then it results in rising prices and inflation as a control mechanism to try to bring that demand back down to sustainable levels. So the key policy implication of both of these scenarios, meaning one scenario is demand shrinks down below potential GDP, and the other is that it exceeds potential GDP, so you have a shortage of demand or a surge in demand. The policy implication from Keynes's perspective is that government intervention is necessary to close the recessionary gap and the inflationary gap, whether by stimulating spending or trying to curb it during inflationary booms. To bring aggregate demand back in line with potential output was the goal that government should take. So now let's break down what constitutes this aggregate demand. We've talked about this before, but let's talk about it again. Aggregate demand, or AD, is essentially the total planned expenditure on domestically produced goods and services throughout the entire economy. Domestically produced. We talked about that before. It's the sum of the four main components: consumption expenditure, C, which is spending by households; investment expenditure, I, which is spending by businesses on new capital goods; government spending, G, which is the expenditures by the federal, state, and local governments; and then finally the net exports minus imports, X minus M, which is the value of our trade imbalance, basically. We will now take a closer look at what determines each of those four components. So let's start with the consumption expenditure. That's typically the largest component of aggregate demand. It includes all spending by households and individuals on things like durable goods, which are things that last a long time, like cars and appliances, and non-durable goods, which are consumed quickly, like groceries, and also services, which are intangible things people buy, like healthcare, entertainment, or your college education. Keynes identified three primary factors that significantly influence how much people consume. The first and often the most powerful is disposable income. This is the income you have left over after you've paid all your taxes, and it directly dictates how much you have available to spend. The second is the expected future income. If consumers are optimistic about their financial future, maybe they expect they're going to get a raise, or they're going to have stable employment, or they're about to get a new job, or they're going to graduate from college and they think, money's going to roll in. They're more likely to spend today before they actually have that money. They might even take on some credit card debt, right? And that boosts aggregate demand. Conversely, though, on the opposite end, widespread pessimism about the economy tends to make people pull back on spending. And we're in June 2025 right now, and that's kind of where we're at. Factors are, it's a little unclear. The first quarter GDP was not good. Second quarter, we're going to find out in about a month from now what that looks like. We may find ourselves in the official definition of a recession in terms of two quarters of negative growth. It's hard to say. We had a big shock with the April tariffs, and that really scared a lot of people, and it created a lot of not so much pessimism, maybe pessimism, but mostly just uncertainty. And uncertainty, like pessimism, can keep people from spending on things. You may hold back those major purchases. Right. Now, a third factor that Keynes identified was wealth or credit. So when households see their wealth increase, for example, due to a rising stock market or appreciating home values, then they're going to feel more secure, and they're going to be inclined to spend a larger portion of their income, and they're going to save less money. We saw this during the dot-com boom of the late 1990s, where savings rates declined. Conversely, a decline in wealth, like the drop in the US stock market in 2008 to 2009, that tends to make people a little more cautious, which means they increase their savings and decrease their consumption. Access to credit also plays a role, as it allows people to spend beyond their immediate income, particularly when their perceived wealth is rising. Like we said, you're more likely to spend money on your credit card if you think you have money coming in later to pay that off. So next we turn to investment expenditure, which is the spending on new capital goods by businesses. This isn't just financial investment in stocks or bonds, but rather it's spending on tangible assets that enhance future productivity. So that category includes producers' durable equipment and software, non-residential structures like factories or office buildings, changes in inventory, goods that have been produced but not yet sold, and also residential structures like new homes or apartment buildings. So while businesses undertake the first three types of investment, households are responsible for those residential structures. Keynes highlighted the crucial role of expectations about the future in driving business investment decisions. So when a firm considers investing in new plants or equipment, they weigh the expected future profits against the cost. If you ever take my finance class, well, all of you will because you're in macro, then we'll talk about what's called capital budgeting. Capital budgeting is a direct result. That's exactly what we're talking about here, where we weigh the future expected revenues and profits against the initial upfront cost of an expansion, a project, a piece of equipment, what have you. So there's a lot of guesswork involved in that, but that's the idea. If you're bullish on what those profits are going to look like, then you're more likely to have a positive, what we call net present value, which generally means you want to move forward with the project if you have a positive net present value. A lot of time value money stuff in there, a lot of interest rate stuff in there, a lot of crossover with what we're talking about, but that's a finance topic. All right. So the clearest driver of investment is the expectations of future profits, right? If we can predict the future, we're going to be golden, right? If we're confident the economy is going to grow, right, then we're going to anticipate a larger market for our products, which is going to encourage new investment. For instance, the U.S. investment surged in the late 1990s as the economy boomed, but it quickly fell during the 2001 recession when the dot-com bubble burst. Interest rates also play a significant role here because we're talking about big expenditures. So just like we borrow money for homes, businesses often need financing for large investments, and that interest rate represents the cost of capital, the cost of borrowing, or at least the opportunity cost of using existing funds if you're not borrowing the money. Right? There's other things you could do with that money other than this project. Lower interest rates make borrowing cheaper and investments more attractive. So that stimulates investment spending. Presidents of the United States are constantly on the Federal Reserve about lowering interest rates so that we can spur investment. But remember that relationship between interest rates and inflation. If the interest rates come down, the inflation goes up. So the Federal Reserve is not likely to, well, we're going to talk about this more when we talk about fiscal and monetary policy, but generally the Federal Reserve is less likely to bring interest rates down when they're experiencing high inflation. There's a direct relationship there. Other factors like energy prices or government tax incentives, that can also affect the expected profitability of investments and consequently aggregate demand. It's worth noting that Keynes observed business investment is the most volatile component of aggregate demand. It's a lot easier for a business to say, we're not going to pursue this project anymore than it is for a college student to say, well, I've taken 2 years. I'm not going to go my third or fourth year because I'm not sure what the economy is going to look like. No, you're going to continue. If you put 2 years in, you're going to do year 3, you're going to do year 4. Nobody cares that you only have, if you don't actually have the degree, they're not taking you as seriously. You got to finish, right? You got to get to the finish line. That's not a good example because this isn't a community college, so it's a 2-year program. But you get my point, right? If you only took 1 year and you didn't go the second year because you thought the economy was going to tank, that's, most people are not going to do that. But businesses do it all the time because they don't have those kind of, they understand sunk costs, whereas we as individuals, we don't. The third component of aggregate demand is the government spending. And that's expenditures by federal, state, and local governments. And it plays a very significant role even in market economies like the United States. The United States federal government is the world's largest customer. So governments provide essential public services, national defense, transportation, infrastructure, education. Keynes recognized that the government budget offered a powerful tool for influencing the aggregate demand. Not only can direct increases in government spending stimulate aggregate demand, but changes in tax rates can also influence private consumption and investment spending. Keynes concluded very famously that during extreme economic downturns like a deep recession, only the government possessed the power and the resources to effectively move aggregate demand and stabilize the economy. For example, during the 2020 pandemic, we had a little tiny recession there. The US federal government provided all kinds of aid, substantial aid to state and local governments and to your own pocketbooks. They did expanded unemployment insurance. They issued direct stimulus checks to households. These measures were Keynesian in nature. They were aimed at shoring up the aggregate demand when private spending collapsed due to the widespread business shutdowns and job losses. My wife got a check for, I don't know what those stimulus checks were, like $1,200. She bought a bicycle, bought an $800 bicycle from Jeff's bike shop. Yeah, I looked back here because we kept it back here for forever. It's in the garage now because I got tired of looking at it. She doesn't take it out. She doesn't use it. But she spent that money right away. You know, I took my time with my spending, but that was the point, right? The government gave you that stimulus so you could spend it as fast as possible. Finally, let's consider net exports. That's the fourth component of our aggregate demand. This is defined as the value of a nation's exports, domestically produced goods that are sold abroad, minus the imports, foreign produced goods purchased domestically. And since aggregate demand focuses on spending on domestic goods and services, export expenditures are actually adding to aggregate demand, while import expenditures are subtracting from it. There are two primary sets of factors that can cause shifts in export and import demand. First, changes in relative growth rates between countries plays a big part. If key trading partners like Canada, Japan, or Germany experience a recession, their demand for US exports is likely going to decline. Conversely, if the domestic economy is booming with higher incomes, people are more likely to purchase more imports. Second, changes in relative prices between countries are also important here. If the US goods become relatively cheaper compared to goods produced somewhere else, perhaps due to technological breakthroughs that reduce production costs or changes in exchange rates that make the dollar weaker, then US exports are likely to rise. And on the other end, if US goods become relatively more expensive, perhaps due to a stronger dollar, then exports are likely going to decline. So to bring all these components together, let's take a look at table 25.1 here. I'm not going to zoom in because it pretty much is the whole slide there, but this table summarizes the determinants of aggregate demand. For consumption, decrease in taxes, increase in income, lower interest rates, a desire to save less, rising wealth, or optimistic expectations about future income will all lead to an increase in aggregate demand. A lot of that's psychological. Just is. The opposite factors will cause consumption and thus aggregate demand to decrease. For investment, an increase in the expected rate of return, profits, a drop in interest rates, or a rise in business confidence will boost aggregate demand. Decreases in these factors will reduce aggregate demand. For government spending, direct increases in government spending or decreases in taxes will stimulate aggregate demand, while reductions in spending or increases in taxes will contract it. And finally, for net exports, an increase in foreign demand for our goods or a relative drop in the price of US goods will increase aggregate demand, and a decrease in foreign demand or a relative price increase of our US goods will cause aggregate demand to decrease. So just that's a comprehensive overview there of the myriad factors that can cause aggregate demand to shift to the left or to the right, which is the central theme of Keynesian analysis. All right, so that is going to stop us here for this one. In the next section here, we'll talk about the building blocks of the Keynesian economic analysis. So I'll see you all in that one.